to many, and although Khatija has spoken at a number of our forums, this is her first time at our online series. So thank you, Khatija, and welcome. I'd like to commence with your thoughts on, obviously, Emirates NBD put out their note earlier this week indicating a revision of the outlook for oil prices for the Gulf economies. And now we have the OECD yesterday revising upwards quite significantly the outlook for global economic growth in 2021. I'd welcome your thoughts on all of that upgrading that's going on, and it should bring a smile to everybody's face, I suppose.
Yes, although I will say that the direction of our forecast revisions was downwards, not upwards.
And it was upwards on oil price, wasn't it?
Yes, so the price has gone up, but in terms of our growth estimates for the GCC, those were revised slightly lower because, of course, by delaying an increase in production even more than has been delayed already, the drag from the oil sector on headline GDP growth becomes much bigger than we had initially expected for the year. So that's really the main reason. Now, a lot of people, when they hear about higher oil prices, they get excited about growth in the region, and that's assuming that governments use the extra oil revenue to boost spending and investment. Now, we have not made that assumption in this case. So we have assumed that governments actually use the oil windfall from higher prices to actually narrow their budget deficits rather than commit to increased spending, which is quite hard to undo when things go the other way. And so what we've seen over the last couple of years is, budget deficits across the region really since 2015 have been quite significant. So we've had 5 years of sort of running down reserves in order to plug gaps in the budget deficits, and a number of measures being introduced across the region, especially last year, to try and diversify revenue sources and also to reduce budget spending commitments. So I don't think that what we still see is a relatively short-term increase in oil prices will translate into long-term commitments on higher spending. So I think at the moment, we expect more of a focus on deficit reduction, repairing budgets, building up potentially reserves again, and then just waiting to see how the demand evolves, because that obviously will determine to some extent the longer term trajectory for oil prices.
Let's welcome James McCallum, Executive Chairman of Xergy and Professor of Energy at Strathclyde University. James, welcome back to the table. This morning, as noted, we're seeing Asian oil prices decline for the third day in a row, and that's after OPEC has made this sort of unexpected restraint on oil supply looking forward. And we've had the OECD come out with fairly positive outlook numbers. Why are prices falling?
I think for me, fairly straightforward, that the prices up in the 70s just aren't seen as justified by the markets as a whole. To be honest, I was personally surprised at the size of the bounce on even off the back of the announcement being a surprising announcement, although, as you will recall last week, there was quite a bit of chat in the chat room, Sean, around, would the Saudi cut be replaced by a more broad cut from the other OPEC producers? And that was something certainly which I was interested to watch and consider. I didn't, like everybody else, I didn't see OPEC retaining the cut and if you like, bearing the burden of that. But for there to be a sort of a $5-6 bounce off the back of that on the basis that a return of 1 million barrels of production was already built into the sort of the prices at $65, $66, $67 a barrel. I just didn't see it, and I think that's unwinding now. I think it's coming off in the market, as I think Russell said yesterday. There was no apparent material damage in the recent attacks, and so the fact of the matter is that we're getting back to pretty much where we were before the OPEC meeting. There was 1 million barrels off the market. There's still 1 million barrels off the market, and the price is softening.
Well, there's still actually about 8 million barrels of oil off the market, given the if you add up all of the different pieces, and I suppose that's one of the underlying or overbearing realities of this oil market. But Victor Yang, senior editor, JLC Network Technology, joining us from China. Again, another bullish outlook from China to add to the OECD optimism for global growth. We have data overnight. China's factory gate prices rose at the fastest pace in 2 years in February, with manufacturers busy at work in China. So demand looks pretty solid there.
Well, yes, well, indeed. Well, it's growing quite fast. I mean, probably the fastest over the past year also. And now you see the country, the tension is now on the two sections. One, and we had just come up with this targets about for the economic growth was about 6%, and this target is quite moderate. So as China is trying to promote high quality development, say we are not focusing on the fastest growth as before, and the government is trying to trying not to put so much pressure on the local government. Well, if they put the target, they set the target too high, well, the local government might be under too much pressure, and they might have to go into a lot of loans to develop. So this target, is quite proper. I mean, say it's quite conservative. And so, but meanwhile, everything is growing quite fast. Well, I mean, say at the two sections, one of the topics is the poverty alleviation. And say by the end of last year, where all the Chinese people have been, I mean, the remaining, about 100 million over the past 8 years have been lifted from absolute poverty. So this is kind of promoting China's consumption and spending, I mean, purchasing power. So
did we see, Victor, in February, because so many Chinese did not travel home for the holiday season, as a result, the factories and the manufacturing was able to get back to work quite quickly than otherwise would have been delayed, and that's why the numbers in February are so good.
Well, yes, factories were not shut as long as before. Say, like last year, where it was, the shutdown was prolonged, but now is actually faster than usual because of the recovering demand and the optimism about the market, the outlook. So basically now, we had actually 15 days for the Chinese New Year, but the holiday was not that long. And some factories were shut actually early, in January. So they returned to work faster than usual in February. And that's also one reason too. But most importantly is about the growing economy. After China contained the resurgence of the virus in late January, weeks, no more new cases, indigenous cases. This gives the Chinese people more confidence. We are now more confident than in the past few months. And that's also one of the reasons for booming consumption too. Even in the holiday, people travel less than usual. I mean, than in the same point in the past years, but still much more than in January. And actually people spend a lot more in the months too. That's for sure. Even if they stay in the place where they were for the Chinese New Year, they spend actually much more than in the January.
They spent more even though they stayed at home. Staycations are expensive.
Yes. Well,
As I learned recently, actually. Khatija, you mentioned in the Emirates NBD note today some points regarding inflation in China. What is your outlook for that and the consequence of it if it picks up?
Yeah, so we saw the PPI number in China rise by slightly more than expected in the latest reading. And it obviously ties into the global story of rising inflation concerns everywhere because of the opening up of the economy, base effects. So last year we had ultra low energy prices during the second quarter, and obviously disruptions to supply and the shutdowns leading to significant price drops for services, for example. And that's all going to be reversed now. So we will see a very high base effect from higher energy prices, high commodity prices, which in fact were the driver for the inflation surprise in China this morning, as well as just a more general sort of the stimulus and consumption recovery is going to boost demand quite strongly over the next few months. But at the same time, the inventory levels are quite low in the United States and in other parts of the world, because we haven't seen a full return to normal supply chains. And so that combination of very strong demand and perhaps slightly slower catch up in supply is expected to also contribute to inflationary pressures. Now, the big question, which the bond market is grappling with and which everyone is grappling with, is to what extent is that going to influence monetary policy decisions around the world? And to what extent is that going to become an entrenched inflationary story rather than simply sort of 6 to 9 month adjustment based on where we've come from and these one-off shocks? And I think that so far the Fed and other central banks, major central banks, have indicated that they see rising inflation this year as transitory. They don't see it translating into a sustained upward pressure on prices for the next 2, 3, 4 years. And as a result, they're willing to look through it, and they're not going to respond in terms of tightening monetary policy on the back of higher inflation readings, which we will get in the coming months. But certainly we've seen a number of indicators that pipeline inflationary pressures are building. Obviously, we had the Chinese number this morning, but last week we had the ISM data from the United States, which showed, I think, a record increase in prices for services sectors in the United States as well. So I think those are really what's driving the concern on inflation over the next 6 to 9 months.
James, the question of whether OPEC Plus made the right decision last week vis-a-vis this tightness in supply-demand balance. We have another story in the digest today about the North Sea going into annual maintenance period in the second quarter, which we would also see replicated in other places. And then the big question mark about US shale. How do you see the sort of timing of the second quarter from the point of view of supply constraints due to maintenance?
Well, we're entering the season for maintenance, particularly in the more hazardous regions of the world, like the North Sea. So we're going to see some of that production, particularly in light crudes, coming off the market. So that's there and understood. I think that's built in. I think if I come back to your the early part of your question, Sean, the decision. Reading Matt Stanley's piece on the Gulf Intelligence press release yesterday, I think is relevant, where he says, you look back at that decision now and it seems like, I think he says, a no-brainer. I think I would draw attention to the fact that clearly that decision coming out of OPEC is to surprise the markets. I think is a very, very cleverly calculated behavioral pattern which is out there, which is actually back to my favorite thing of saying OPEC Plus is doing a fantastic job at the moment of controlling the maths on all of this. What happens
not
if
if you're India, because
No.
is I mean, these are some of the consequences ultimately. India have come out in the last 24 hours instructing their refiners to sort of divest from their dependency on Middle East oil. I mean, these are some of the decisions back and forward. There is costs to this.
Yeah, I saw that, and I must be honest. I read that article, and I was a bit surprised by it, Sean, because at the end of the day, diversifying your supply to other suppliers it isn't going to yield you a lower oil price when OPEC Plus is having such a significant and tight control over where the prices should be. I mean, I would draw your listeners to read Khatija's article down under recommended videos and reports. I thought it was a terrific article, Khatija, and it drew my attention particularly to a couple of things which I think are incredibly relevant if you're setting pricing policy on oil, which is at what level are you matching your budget deficit if you're a Middle East country? Now, clearly, your point around India, Sean, is that India enjoyed oil prices when they were $40 a barrel and doesn't like it when they're up at about 67, 68 or thereabouts. But if you're Saudi or you're the United Arab Emirates or you're Kuwait, you do enjoy that. I'd love to hear Khatija's view on the prices where she's actually looking at where the GCC countries strike a balance on their budget deficits with. I think Ted Mulderhall on the chat room is drawing attention to the EIA's report in terms of oil price predictions for 2021 and 2022 of around $61 a barrel, then subsequently $58 a barrel in 2022. So clearly at $67 a barrel, your report, Khatija, reflects that things are beginning to get to a place where if you're a GCC producer, you probably feel like you can go up a little bit, down a little bit. But if the EIA are right, then we've still got quite volatile markets ahead of us.
Yes, I mean, thank you for that. And you've exactly hit the nail on the head in terms of why we don't think governments in the region are going to suddenly boost spending on the back of higher oil prices this year. We don't think that this is going to be sustained because, again, you've got non-OPEC producers, which now have a much bigger incentive to increase production and help bring the price down. And also, even at $68 a barrel, it's only really the UAE which is looking at a balanced budget or a small surplus. The break-even oil price for other GCC producers are higher. So Saudi is probably around 70. And then Kuwait, Bahrain, Oman are much higher. So for those countries, they will still have to do something to fix the structural deficit that they currently are faced with. They will still have to make efforts to find other sources of revenues. And that really means higher taxes in some form or another. Or, and a combination with, they'll have to restrict their spending growth going forward. In order to sustainably be able to balance their budgets going forward and not have to be subject to the shocks which the oil price can then impose when it's moving around in the way that it has over the last year and probably will over the next couple of years. So I think, caution is really the name of the game on the budget side. They cannot rush out and boost spending because there's absolutely no guarantee that oil prices are going to stay at $70 a barrel for the foreseeable future. And once you've committed to increase spending, it's very difficult to take that back.
Victor, another issue that has been impacting the China has been the congestion at the ports and the standoff with Australia. We finally saw this week the coal ships that have been sitting for over 260 days waiting to discharge, where one or two of them finally allowed to offload. What is the status at the moment regarding the congestion at China's ports?
Well, yes, well, as you said, congestion is still quite severe at Chinese ports, some ports at least. And as for Australian coal, China has made it clear that it will not, well, resume. I mean, well, actually, the Chinese government says it's because of the coal problem. There's some issues with the coal, and actually, it's because of some kind of remarks by the Australian government. Well, say, and it's kind of provoking the government, the Chinese government, and well, for the Chinese government, the bottom line is, well, if you want to resume, well, normal trade with us, you need to be genuine. You need to stop undermining us. Well, and that's the bottom line for the Chinese government saying, and not combining others and against China when you're doing business. Well, particularly by fabricating some stuff against the Chinese government. That's not acceptable.
And your coal will sit for 260 days. That's how unacceptable it is. We'll go cold before we accept those comments. But Victor, in terms of the outlook for oil buying in China in the second quarter, if we see oil prices at these levels, $65, $75 range, will that slow down China's oil purchases?
Yes, probably. And just 2 days ago, data came out that China crude imports in the first 2 months of this year gained 4.1%. But the actual number might be larger because well, some cargoes were imported under the name of diluted bitumen. Say several million metric tons of diluted bitumen were imported in Shandong by independent refiners. Well, but actually some of these so-called diluted bitumen have very similar specifications to crude oil. And you might consider it's basically crude oil, but the source might not be clear. And so the countries who actual imports in the first 2 months will probably gain more than 4.1%. Well, in the first 2 months. Well, and as for the demand in the second quarter, well, say we had peaking maintenance from March to April, mostly in April. And so, and now prices are about $70 or so, has kind of depressed demand from China. And now we're also looking at, well, the sanctions on Iran. Well, it's possible if the US will leave the sanctions on Iran in the near term, say, well, cargoes from Iran would be back to normal, say like it would be able to, well, handle, well, normal trade with other countries, well, say, and crude oil imports from Iran, well, would be different. Well, and
you're saying that you could see China importing more oil from Iran?
Well, for now, it is said that Iran oil is sold below market prices, well, say, to some countries, well, say. So that's not a fair competition. So, but once, well, the United States lift the sanctions on Iran, the price might go up. So it might not actually buy more crude from Iran, but it could also buy more. That's possible. But now, and China's crude, imports, well, say, because some independents will buy crude oil under the name of diluted bitumen, say mostly crude oil. So the data is not all indicated by the JLC. So, right. but in the second quarter, because of a lot of maintenance, and high prices now, this could depress demand to some degree, but it will still, probably still growing. It will still be growing. Yes.
Well, at 6 to 7% GDP growth for the year, you would expect that oil demand in China will continue to grow. Let's go to the survey question and get the view of the room on the declining oil price this week. Oil prices are falling for a third day in a row, and so vindicating OPEC's decision to keep supply restrained in April. Agree or disagree? Agree or disagree with that statement? and we will go to our speakers for their thoughts. Khatija, one of the other notable upgrades, if you like, in the OECD report was the US, the forecast for the US touching on near 6%, and India, my gosh, above 12% for 2021. But looking at the US, that is a very big number that could pull the whole world behind it.
Well, yes. I mean, there's been quite a series of upgrades on the outlook for US growth this year. And in fact, when Jerome Powell was talking to Congress, was it last week or the week before, he actually also mentioned the Fed is looking at potentially 6% growth in the United States this year. Now, of course, that is coming off a low base, and certainly the progress that they've made with the vaccine rollout over the last month or so has perhaps provided a boost, and then obviously the extra money that's been now approved by Congress to disperse is going to again provide a boost to growth. So I think those sorts of numbers, are much more realistic now than they were, say, 2 or 3 months ago. In terms of, OPEC's decision to hold production at the ultra low level that was supposed to just be temporary, if you've got upgraded growth estimates for all of the big economies, then you should really assume that demand is going to recover in line with that, and so there's actually room to increase supply. So that to me doesn't really tie in with OPEC's decision, and so I get the impression that OPEC is more at this point concerned about maintaining a relatively high price, rather than increasing supply in line with an expected recovery in demand.
Well, I think, James, that is the ultimate question: is where is the demand? As I think the Saudi oil minister said, he wanted to see the white of the eyes of the oil demand recovery. And while we're seeing the numbers from the OECD, there's still a number of cases, a number of situations that give one pause. Europe being one, even though the UK is getting its vaccinations right, Europe is not. The US is facing other challenges. But ultimately, to Khatija's point, the demand is there now for more barrels. What's your thoughts on that?
Yeah, I think the demand is strongly coming back for more barrels, and I think there is definitely the perspective that whilst in some places like Europe, the line has pushed a little bit to the right over where everybody would wish it to be, whether there's another wave coming through in the Eastern Mediterranean, even.
So
even
would we
Italy
say that COVID is now kind of like no longer Category 5 hurricane? It's now Category 3 and joins the queue alongside, unemployment and I don't know, whatever other types of problems that would curtail demand growth. But it isn't the tsunami.
Yeah, there's certainly a growing tendency amongst people to want to get back to norm, or the norm that they actually see operating, as you've frequently said on this week. People wanting to go out and book their next travel ticket somewhere. That's definitely a sentiment which is echoed in almost every conversation one has. So yes, I actually voted agree on the question there. I think we've got a situation where OPEC are endeavouring to hold up prices just now, but they're also, through the sort of surprising nature of the way that they're actually doing it, also wanting to send a strong message to the financial bond markets in the United States that says, yes, we're holding prices up above 60, but don't think that we're not monitoring what's happening to shale oil production in the United States. If things suddenly bounce back there, and there's a wholesale return to investing in shale oil, we'll just pull back that price and we will control that to make sure that we are in the driving seat. I think that's what we're seeing.
Let's get the survey result before giving Victor the last word this morning. A big 72% agree that this price fall vindicates the OPEC decision. Victor, you mentioned earlier, and again, this is another big point for where this year will go, exactly what growth we will see in China. You said that the 6% that was announced was quite moderate. What do you think, what would the expectation be that would not be moderate, that would be more realistic? We have the OECD yesterday said 7.8%.
Yes, well, some estimate about 8% of growth. Well, and that wouldn't be too hard to achieve. Yes, because of the low base for last year. But the Chinese government is not focusing on faster growth now. It's more focusing on high quality development, say like the upgrade and transition of the industry, and say some kind of technological innovation. So it's kind of focus for greener development. And
why would China, the government, the leadership, downplay growth? Typically, that's a number they like to boast about and make it big.
No, that's not the case. Well, you might say, well, in the past, you might say it could be, well, it could be true with local governments. Well, but now for both the central government or the local government, they do not boast the GDP number. It is more about, well, high quality development now. And now the central government doesn't say that they would judge the officials' performance by the GDP growth. Well, actually, the most important one is, well, whether you can create benefits for the people and how much you improve people's life. That's the basic point. That's the most important one now.
So you're off the hook for the GDP number if you're a regional government minister or whatever the position might be. Thank you very much. We'll wrap it up there. Just to flag our halftime talk interview this week, we sort of focused it on 2 interviews to sort of address 2 big subjects that came up this week. One is the Iran-US rapprochement, and of course the situation in the Saudi Arabia, what happened there over the weekend, and also the plans or the discussions underway to reformat the Brent benchmark and what the outlook for that will be. But let's finish. Thank you, Khatija, very much. Thank you, James. And also thank you to our speaker in China. Always great to have that voice come true. All the best. Have a good day, and we'll catch up with you all during the week.
Thank you.
Thank you, Khatija. Thank you, Sean. Victor.
Thank you.
Bye-bye.
Bye-bye.